let me start with introducing Andrew Holland. Andrew is CEO, Avendus Capital, Public Markets Alternate Strategies. Andrew previously was the CEO of Ambit Investment Advisors, where he built one of India's largest and most successful hedge funds. Andrew has also served as the Managing Director of the Strategic Investment Group, as well as the Chief Administrative Officer and Head of Research at Merrill Lynch. He successfully built DSP Merrill Lynch to a research brokerage house rated by Asia Money, Institutional Investor, and Greenwich. Andrew has also worked at County NatWest, Barclays, and Credit Suisse. Please join me in giving him a warm welcome. And Andy, please take a seat. Next, I have the pleasure in welcoming Benaifer. Benaifer is the Chief Investment Officer, Ray, the Patni family office. She is responsible for investment management of the group. In addition, Benaifer is a director on the board of Bombay Shirt Company and an advisor to the board of Waterfield Advisors. Previously, she worked at Citibank, ICICI Prudential, Royal Bank of Scotland, and Smith Securities, and served as a director on the board of Nirvana Venture Advisors. Benaifer's forte is setting up new businesses, and she has experience in identifying early stage and unlisted company investments, succession planning, and estate management. She has also raised funds for early and mid-stage companies, and she has an MBA from JBIMS. Benaifer, please take your seat. And audience, may I request you to kindly welcome. Next up is Rajeev Thakkar. He is a CFA charter holder as well, is the Chief Investment Officer and Director at PPFAS Mutual Fund, popularly known as Parag Parekh Mutual Fund. He has over 2 decades of experience in various segments of the capital markets, such as investment banking, corporate finance, securities broking, and fund management. Previously, Rajeev was the fund manager for the portfolio management service called Cognito at PPFAS Private Limited. He is a strong believer in the school of value investing and is heavily influenced by Warren Buffett and Charlie Munger's approach. Rajeev is a regular contributor to Mint newspaper and has appeared on such business channels as Bloomberg India and ET Now. May I request you to please welcome him warmly, and Rajeev, please take it. Lastly, we have Geoff. Geoff is the director with Fortress Capital Asset Management, a pan-Asian fund management company. With over 2 decades of multi-asset class and strategic investments proficiency, Geoff was previously CEO or ED with Hong Leong Asset Management and Senior VP Global Emerging Markets at Dubai Investment Group. He has also held the position of CIO at Pacific Mutual Fund. For the interest of the CFA charter holders, Geoff is an incoming governor to the CFA Institute's Board of Governors, and I am told he resumes office tomorrow. So, Geoff, may I welcome you here. He has also served on the Education Advisory Committee, Practice Analysis Subcommittee, and Council of Examiners, as well as Vice President and Treasury for CFA Society Malaysia. So, may I please request you to welcome him warmly, and Geoff, please take it, sir. So, let me start the session with a question on what we understand as asset allocation, topic being advances in asset allocation. And based on your experience, please explain in terms of how has it been relevant to investors. Question to Geoff initially, and then we take it across the panel. And do most successful investors practice asset allocation?
I think on their own, on their own respect, I think very few consciously do it. A lot of them would see their respective asset classes as standalone, and it really takes advisors like yourselves to educate them in terms of how all these asset classes work together in terms of achieving specific goals or objectives.
So, do you want to elaborate from an international standpoint? How has the concept of asset allocation evolved in a wealth management industry?
So it's you know, if you look at using portfolio theory to try to describe how asset allocation has evolved through the years, it's essentially started off very basically like, for example, picking a few stocks and putting it into a virtual portfolio, right? And then, of course, with education and with advice coming from professionals, we've then sort of like graduated into this mean variance portfolio theory type of portfolios. And then now we're evolving further into a needs-based or rule-based type of asset allocation.
And Rajeev, based on your experience, I know as an asset manager and with a single strategy, there would be always this concept. In fact, Charlie Munger, since you are a believer in Charlie Munger, he mentioned that to be rich, you don't have to diversify, and essentially he mentions that he has only 3 stocks. So how do you reconcile to a fact that asset allocation, it's important, and the fact that it doesn't necessarily make you the richest?
Sure. So to the question that does asset allocation play a role in achieving success, first we would have to define what we mean by success. Now, success would mean different things to different people. If it is meaning that you want to achieve a certain goal, surely asset allocation is relevant. If the definition of success is you want to achieve the highest return possible, then there can be by definition only one asset class over a period of time, which would be the maximum generating asset for that period. So I think people get confused as to what they essentially want to do. And we heard the speakers in the first 2 sessions where people spoke about wealthy individuals or family offices. I think for the entry-level investor, it's very easy to do asset allocation given that some of it is statutory provident fund or statutory allocations. Wealthy individuals where they may not have a primary goal, it becomes more difficult. So I think if we define what is the objective, asset allocation flows very smoothly. In the absence of an objective, you tend up going all over the place. Single strategy investors would be vehicles for people to use once they decide on the allocation. Primarily, we do not have a role to play when deciding asset allocations.
And yeah, question now to Benaifer, similar one, but really from a family office orientation, and in fact Rajeev was mentioning about the structure and the framework that's required, and then to define an objective. So you've been, for a fair bit of time now, as part of a family office, and also looking at possibly investment ideas across, and also you've been sitting on board of multi-family offices as well. So what do you feel, from a client perspective as an outsider sitting on a board of a multi-family office, and also from an insider perspective, being a CIO of a fairly well-structured, sophisticated family office?
So I'll take the second part first, because that's something that I had the fortune of converting some of the theoretical books into practice, because we actually set up the family office pretty much from scratch. So the experience has been very interesting. It's been something which is which you could draw up based, like Rajeev mentioned, you will first draw up the objectives of what is required to be achieved, and then probably lay down the framework of discipline into how you wish to practice it, maybe with a tweaking of about 5 to 8% every year, till you actually got the normalcy pattern across a 3-year period, which would probably test the hypothesis, at the same time show whether the end goal or the objective set is actually getting achieved. So I think it's been a slower bit of setting it up, but it's been extremely structured and disciplined from the time we hit the word go in the family office side, and that has helped us beautifully. Whilst on the other side, like you mentioned, on the multi-family office side, the lens that I have of most, I would say, affluent families that exist in India, I think the experience or the whole venture started with the fact that we established it that it worked well for us, and we thought that the Indian ultra HNI should actually have a disciplined approach and a manager who can help them with it. The inherent families that actually came were very product driven. Most of them would buy out of their comfort of product or people. As we progressed in the journey, of course, it's been a learning for them as well as for us into what are the triggers which actually cause decision making by certain individuals. But yes, now as we speak, I would say about half of them who've been on board with us for at least 2.5 years now, they do follow a disciplined approach to allocation, and as a result, I wouldn't say have achieved all the objectives, but are in the process of achieving them.
Okay, thanks. So, Andrew, question to you. I mean, you pioneered really the concept of hedge funds in India, and right from your earliest stint at Ambit and now in Avendus. So, and then alternative strategies. In the earlier presentation, I find Karan referring to alternate assets as the real core in terms of allocating to HNIs and ultra HNIs. So how do you see that change, you from almost a size 0 to becoming a larger portion of an HNI's allocation? How do you see that, and what do you think are the key drivers that helped achieve that?
So just on the first part of the question you asked before, which was asset allocation, whilst I'm not an asset allocator, I think to say that you shouldn't be an active asset allocator would be incorrect, because there's been this saying for some time now, particularly now with equity markets where they are, is that it's not timing the market, it's time in the market. So I stay there for a long time. But I just go back to the fact that if you would have invested in the end of 2007 in equities till 2013, you would have been underwater. So it's not just the asset allocation equities which you can have, but it's the opportunity cost of being in equities for that 5-year period and actually leaving all asset classes alone. So I think you have to be more active. In terms of hedge funds, what we had traditionally in India was obviously debt and equity, debt being low risk, equity being higher risk. I think what hedge funds have done is to take us along the risk curve from the debt through to equity. And I think that's finding a lot of encouragement from the distributors as well as wealth managers and HNIs, because it does diversify their portfolio. And obviously globally, alternatives can represent nearer to 20% of people's portfolios. So it's a growing industry, and I think we'll find that more and more investors will want to go around the risk curve. I mean, most people ask me today, if I'm talking about markets, for example, should I buy now? Tomorrow we could see a fall, whereas I think hedge funds can take you along that risk curve a lot more easily. You might have your equity exposure. You don't really want to kind of miss out if you feel you might miss out, but you also want to protect your capital at the same time, and that's what hedge funds can do.
So protecting capital and not really taking risking capital too much. I mean, and that's where Jeff, you mentioned about some of the trends that could come in internationally, and that applies to risk budgeting. What is this concept of risk budgeting, and how does it work in the paradigm of asset allocation?
Well, I think the concept of budgeting for risk really comes from essentially behavioral finance, right? Where the utility that an investor gets in terms of losing money, or should I say the amount of pain that an investor goes through if he or she loses money is substantially more than if they were to make money. So risk budgeting and asset allocation really comes in to try to manage the downside of investing. And that really is parallel to making a goal. When you're setting up a portfolio that is goal-driven, risk budgeting merely puts into perspective that you're allocating risk to specific factors within the asset allocation, such that your investor does not have to go through periods of substantial risks in terms of drawdown. So, so it's really a very simple concept. It is not difficult to fathom that depending on what your expectations are, where you would have to probably forecast potential returns into each asset class that you're looking at, as well as what the potential risk of those returns are, that would then basically play back into your risk budgeted asset.
So from a wealth management firm point of view, so when it comes to risk budgeting, what are the performance metrics typically they would apply from a client in a client's portfolio?
Well, I mean, again, it's all, the only real measures that we have would be historical, risk return measures like standard deviation, variances, and that kind of stuff. So again, it's trying to look back in terms of what has happened in history and trying to project forward to make your risk and return expectations. So from a scientific perspective, it doesn't really change. It's just, of course, using technology to be able to process substantially a lot more data to probably make better decisions as a result of that.
So Rajeev, I'll come back to you with a question on behavioral flaws and what could be and how typically you address in your model. But before that, I want to ask Benaifer a question taking off from where Jeff left off in terms of the risk budgeting. Do you use that as a term, or you feel that this is fairly common in terms of the structuring for a client, either inside your family office or multi-family office? Do you think risk budgeting is a common thing in India amongst clients?
I think it's a very essential thing. First of all, when you're trying to maintain and build a portfolio and keep it at a certain rate. But I think the most important learning I've had on risk budgeting is that you constantly need to evaluate it and readjust it with the changing underlyings and the changing scenarios, both internationally as well as domestically. Because nothing that you start investing in it at day one with the pre-assumed risks continues to stay there, and that's why I would think that a monthly or a once in 2 months kind of readjustment, which requires you to take 2 steps back and just look at the whole bit again and see whether your base assumptions on those have actually played out in the manner that you think, and whether the risk weights that you had adjusted at that particular point in time actually hold true in the future course as well.
Okay, thanks. So Rajeev, question to you in terms of, typically what are the common behavioral flaws that you see in clients, and has it been common all across time periods, or do you see some changes in terms of the behavioral flaws, some flaws being more predominant now and than they were before? And also to address, I think, questions on hope and fear, my statement had mentioned, and as well as regret aversion, that was a point that came across. And how do you, being a retail fund manager of retail asset management, how do you ensure that there is a quality of capital aligned to your philosophy, and so that you, from your philosophy point of view, you don't dilute it?
Sure, that's very interesting, and just pre-lunch we had a wonderful session with Mr. Meyer-Statman, and one of the mistakes that we see more on the affluent side is that people get carried away by the expressive benefits of some of the exotic structures. So AIFs are wonderful for a differentiated offering, or a portfolio management service is wonderful for a maybe a small cap, mid cap focus, or a differentiated product offering. But if it is going to be long only buy and hold kind of thing, maybe a fund structure could be better for affluent people. The other thing is that many a times, in the absence of a clear cut goal, saying a retail or a small individual investor would have a asset purchase goal for a vehicle or a house or retirement or a education. In affluent customers, when that is not very well articulated, people get carried away with tactical asset allocations, meaning next 6 months we see this asset class performing better than the other, and there's more shuffle than what is required, and then to an extent there is a backward looking return chase, or there's this regret of not being in the highest return generating asset class, which is probably in our mind better handled by some of the disciplined individual investors, which is ironical because larger investors are supposedly the smart money, whereas the individual investor is the dumb guy, but sometimes it gets flipped around. As far as aligning investor goals with our own investment style is concerned, we take communication very, very seriously, whether it's communication with our distributor partners or whether it's communication with our direct clients. We tend to err on the side of over communicating rather than under communicating, so that the expectations are set right as to what we can deliver and what kind of behavior they should expect from our investments. And I think that is very, very important for all three stakeholders, the manufacturer, the intermediary and the client, for all three to be happy at the end of the day.
So do you see a change in terms of the behavioral flaws which dominate now than they were maybe before? I mean, is there some kind of a trend where you see more of this than, or are all the flaws fairly consistent across time periods?
So what has happened is the choice architecture has increased, given that you have InvITs, REITs, you have angel investing, venture capital, private equity, overseas investments, AIFs. The choice architecture has increased, and what is commonly referred to as FOMO, or the fear of missing out, is becoming more active. So I think the churn has increased to my mind, which is actually harmful to the investor returns. And also equities, which used to be a tax-free asset class beyond a year, that is now a taxable asset class. So actually with the increased churn, apart from the impact cost and transaction cost, taxation is also a factor. I would think that to an extent we are regressing rather than progressing in that sense.
So Andrew, a question, I think a follow-up from what Rajeev has said, and a little, I would say that trying to be a little provocative here, is in terms of, one of the interesting insights that came to me was, if we had checked out on the performance of portfolios across the time period, say it's 2008 to now, I think the best performing portfolios are the ones that show the best return for the investor was in terms of the portfolios that were not churned at all, or that were not at all active during that period. And that also comes across in a fairly consistent way across time periods in the Dalbar research that is conducted in US, and where they address it to a behavioral flaw. So you mentioned about in your in the early response that one needs to be active, and possibly investors may not like the kind of fall that they would see in a short term. I mean, if they take a decision today, maybe tomorrow, day after, they won't like to see the portfolios in the red. So how do you react to that, and how do you assess that your portfolio is best suited even for the longer term and also from a strategic perspective?
So I think the point, maybe I didn't make it clear on the 2008 to 2013, was about active asset allocation, not active equity allocation. So you might have, I don't know, 50, 60% allocated in 2007. I'm saying is that if some of those assets weren't in equities for 5 years where you're underwater, you could have made more money in other asset classes. That's what I was saying, rather than being just one asset class. See, I think with AIFs or hedge funds, you've got to be very clear in what you're trying to deliver for your client or for the fund. So if I take our flagship product, the Absolute Return Fund, it really is a fund which is trying to target a gross return of 15 to 20%, irrespective of markets, whether they go up or down or sideways, with a volatility of 5%, which is in line with your long-term bond funds. We give monthly liquidity. So we're after the client's debt money. I'm not after his equity money because I can't compete with equity. So it's very clear in what you're trying to tell the client. And the second fund, which is the Enhanced Return Fund, that is trying to get your equity money. It's a 3-year product with a 15-month lock-in. But then you're trying to reduce the downside when markets fall, but enhance the upside when markets are good. So that's a different type of product. So as long as you're going along the risk curve, right, because we typically just do debt or equity. That's what I remember here. And there's, yes, there are new products, more exotic products, which I don't understand, but they might give you better yield. But I can tell you now that if bond yields go to 10%, a large amount of money will go back into debt. I mean, why not? 10% is an easy return to make with guaranteed returns. So I'd be doing that. If I was an asset allocator now, I'd be thinking about that.
So Benaifer, I mean, I think what Rajeev mentions is exotic products, and HNI is kind of getting excited about this. So how do you see that as a family office? Is there some kind of an excitement to taste or experience such products, or is there some kind of a risk control you kind of put in terms of internal disciplines, of course, in terms of the concentration risk that you take, or is there some kind of a thing that you need to experience that, because in any case it's so much money that you are handling, and investing a small portion just to experience that could be one of the choices that you make. But how do you kind of allocate to such products which don't have a fair amount of lineage, but maybe from West or some kind of learnings from elsewhere or other markets, you feel that they could be a good bet for your clients?
So in this context, what I've experienced is that the universe has grown significantly. As far as the way we manage at Ray is concerned, the first learning, at least that we've always stuck to, and probably I've stuck to that in person, is we don't analyze performances. So the lineage part really goes off, because if you look at historic performances of any asset class or any fund manager or any house, there are just too many caveats to it. Was it the consistent CIO? Was it the consistent team? Were the risk management effectively put in place, followed diligently across the whole tenor? I think there are too many aspects in that context. So performance to me is post-dated. Anything which is post-dated is irrelevant. It is not essential that it is replicatable. So that's one, replicable rather. So that's one. As far as newer products are concerned, and this I saw, this is my, across the last 5-6 years that I've been doing this, is there's a lot of excitement when something new comes in. It's almost like when a newer project is getting launched in a Delhi or a Mumbai, where people want to participate because so and so has participated and has a real estate asset there. So I think that's the excitement of marketing. So yes, products excite investors, but I think so there was a time when startups or the early stage companies were very exciting. You're right, because they just became the flavor of the day, and then everyone would compare notes over golf and say that, oh, I missed this and I got that, in that kind of context. So in the AIF space, the way we've participated in it is that make mature decisions which are giving you a hedge to your overall portfolio in varied contexts, where the underlyings are fairly, even if the underlyings are same, the philosophy that it's aiming to achieve is fairly different from what a traditional debt or a traditional equity can deliver. And I think that is what excites us about newer products. So 372 listed AIFs, I think, as of June end, yep, if I'm not mistaken. Predominantly PE VCs, I think about 270, if I have the count right, and about 66 of them which call themselves hedge funds, but truly only 4 which exist.
So what do you make of this trend?
Dig deep.
Okay. Thanks. Jeff, a question from the audience, but I think along with that I'll add some of mine as well here. In a sense that I think the audience question here is, how do you see the role of quantitative tools in asset allocation, and what are the challenges for it? And possibly from here you can take on in terms of the advances in asset allocation there, with particular respect to smart beta or the algos, the quants, etc. So
I think if I can say it bluntly, I think the advent or the popularity of quantitative asset allocation, or just using quant to drive investment decisions, has really been a factor of technology. I mean, technology has very greatly enabled this, but it's also cost, right? As fund managers or as investment advisors, as the the overall cost of running this business increases dramatically. One needs to take a very practical view in terms of how do you continue to be able to operate in terms of your optimal way of making this investment decisions through your analysis and so forth, without necessarily having to employ an army of research people. So quantitative analysis has really taken on a life of its own just because of necessity in terms of us being able to evaluate all the data that's out there. And of course, I mean, with increasing amounts of information that's being made available, one needs to have a more systematic view of making investment decisions and therefore asset allocation as well. So I think on a daily basis from the trends that we've seen, quantitative investment decision making is becoming mainstream. What are the challenges with that? I think the challenge here is that we fail to anticipate changes in historical behavior. We've always been proven time and time again that this time is always different. It is not, what happened in the Asian financial crisis in '98 versus what happened in 2008 are completely different. Even though market drawdowns were pretty much similar, but the underlying variables, the way that investors behaved in each period was substantially different. So I think that's where quantitative analysis is still trying to capture changes in investor behavior.
So what do you make of the evolution of smart beta, and where does it figure in terms of client asset allocation?
Smart beta, again, is not something new. I mean, it's essentially passive investing, being your fundamental building block for your portfolio, and you trying to then overlay specific active strategies on top of that passive strategy. And it's really taken off just because ETFs have become so popular today that ETFs are the ones or the vehicles that essentially form that substantial bulk of your portfolio. And the smart beta, the market risk that you're taking on, which is your active strategy, overlays on top of that. So you could potentially have a smart beta portfolio that consists entirely of ETFs, where you are selecting passive ETFs for a specific view that you're taking that may or may not be what you're benchmarked against. Right? So and then of course today there are also active ETFs out there. So really, smart beta is just an evolution of passive investing as we see it today.
So Rajeev, taking off from there, and the fact that there's a lot of talk in the media about ETFs, the popularity of them, the benefits largely on account of cost, and the fact that overall over a long period, an active fund manager may not be able to keep consistently beating the market returns, so an investor is well off getting into a passive fund. But at the same time, there's another theme that parallelly runs through, is that even investing passively is an active decision. And yesterday I read a report where two giant fund managers actually voted contradicting each other. Both are passive fund managers for Tesla, one for Musk and another against Musk. So how do you see that, and how do you see from an Indian context? Of course, in an earlier session, I think one of them referred that active is the future for Indian markets. So how do you see that? And being an active fund manager yourself, so where do you see that challenge being overcome?
To put context in this, there was this well publicized bet that Warren Buffett had with a hedge fund of funds, saying over a longer period of time whether the passive fund will outperform or the active hedge fund will outperform. I think the key learning from that, and that was mentioned in this year's Berkshire letter, was that be conscious of the cost. Active people cannot continue to work on 2 and 20 and hope to beat the index on a consistent basis. At the same time, given that in India the overall size of the assets are relatively small as compared to the overall market cap, there is still scope for getting these advantages where you can have a differentiated strategy and earn a return which is better than the benchmark. which we have seen broadly over a period of time. Given the new categorization and all, I think in the large cap, there would be increasing pressure for the fund managers to outperform given the TRI benchmarking and given that the choice of securities has been limited with regulation. But I think in the small mid cap and multi cap category, there's still scope for this. Using quants or computers to do work, I think in each field, machines are able to do a lot of things that humans were doing earlier, and I'm sure in the investment field as well, there's ample scope. Key is to differentiate between what can a quant do better versus what a human can do. So something like a Joel Greenblatt magic formula has been working for a long time, and people have their own strategies which can be something like a rule-based investing. I think on top of that, you need human intuition where you can dig deep into accounts and say, this is actually growth investing and it's not routine advertisement expenditure, and that's why what the quant valuation is incorrect and why you can bid up the price. So you can have these things. And again, to the point that there is an element of active investing even in the indices. I just read a report somewhere that as many as 40 to 50 stocks in the NSE mid cap index have been changed in the last 6 months. So even that cannot be really called passive if you have such a large churn in the indices.
So Ben, I have a question to you. I mean, in terms of, and slightly different here, because you also sit on the boards of several unlisted companies where either your company would have made investments or for some reason. So how do you look at it? Is there a theme, underlying theme that you have identified, and basis that you kind of invest into these companies, or is it a passion of the promoters that help take that decision? So what makes you put money?
So most of the time in the unlisted space, it is driven by one or two factors. If you identify a theme as the upcoming theme for the next 10 years, then we look at that. In certain other families, they are intertwine the unlisted space with the passion of the next gen, because they are trying to kind of give a line of business or a learning curve to the next gen through the experience of leading it through another promoter. So that's the kind of experience they have. Some of them, some families, I mean, we also have our own venture fund. So in that case, they want to learn by putting their own monies with a professional manager who they've identified, and they want to learn and probably do the seed or the early stage or the venture and probably move in that direction. Increasingly, we debate most of the times, as far as our family office is concerned, what is the next thing? So for example, we were very bullish on consumer even 6 years ago. Consumers just become a theme just 2 weeks ago, as I understand it. So yeah, so we've been identifying early stage companies, much ahead, simple businesses. So because we always believe in a philosophy of keeping investments extremely simple. The simpler you do it, the more money we make.
Thanks. So Andrew, I mean, the question here is, I think from the audience, that is, how do you see the hedge funds growing in India from here? I mean, are we at a state of infancy now, and you are completely optimistic about the way the size would shape up in the next 10 years or so? And what do you see are the key challenges to it?
I think some of the key challenges are partly regulatory. For example, in AIFs you can only have 1,000 investors, and then you have to launch a new fund. So I think we're all knocking on the door of that regulation already. So we need to increase that. Tax would also be would be great if they could change that, but I don't think that's going to happen. I think when we started off in 2013, we were one of the first to launch a hedge fund, and now we have, as Benaifer said, 4, and there's more coming. Templeton are launching a fund as well. So I think this will be a growing trend for mutual funds as well, to add AIFs going forward. So I can see this being a very big industry. When you talk about ETFs in India, I have no problem with ETFs, but I think this is if we can't make alpha in India, then I don't know what we're thinking about with 6,000 listed companies. I think the other thing that worries me about ETFs, if I look in the developed countries, and we're not developed in terms of our markets, is that I just wonder if this narrow range of companies which are moving indexes, if they fall out of favor for any reason, how we'll be blaming ETFs for the big fall in markets. So it might be flavor at the moment, but it might not be in the near term.
I just want to add one thing to that, and just to on the Nifty mid cap. If you see the Nifty in the mid cap currently, out of 50 stocks, 24 of them are below a market cap of 10,000.
So with that somber note, I think we are 2 seconds away, and we end this excellent session. Ladies and gentlemen, please give a big hand to the panelists who have been very upfront in terms of talking about asset allocation advances, and hopefully we enrich our businesses as we go after the seminar. Thank you all.
Thank you.
Pleasure.